Hello and welcome everybody. Welcome to the Canis Major Deal blog. I'm Phil Grove. Each week we go through an example of a commercial multifamily real estate investment. And this week we have a very special case study on something called the Autumn Chase Apartments. And our presenter this week is Siva Palchuru, who is also the sponsor of this deal, a very successful deal. And Siva, I'm going to turn it over to you to walk us through the Autumn Chase Apartments.
Thank you, Phil. Today we are discussing on Autumn Chase Apartments, as Phil mentioned. Before that, I just would like to give some background of myself. My name is Siva Palchuru. I live in McKinney, Texas. I did my PhD in chemistry back home in India, and I came here to Texas A&M to do the postdoctoral research. And also I finished not only at Texas A&M, but also at Rice University. And I moved on to private industry after that. Then I started my own environmental consulting company, and I sold it in 2006. And then I started investing in commercial real estate since 2008 for mainly to look for passive income. So then I started working with Phil and Shana Agro in 2015. Became sponsor of Canis Major Incubator in January 2017. So coming back to this Autumn Chase apartment deal, this is a typical apartment complex, Class C property, Class C neighborhood. This was built in 1969 with 185 units, and the total square footage of the apartment complex livable area is 130,765 square feet. And this has actually a unique presence, which is 150 apartments are 2-bedroom, 1-bath, and 35 units are 1-bedroom, 1-bath. Why I'm stressing this is because this has more towards the family side, because there are more 2-bedroom apartments. And if you actually look at this property, the survey of the property building, this is all Autumn Chase, where I'm actually the red line area. And the back of this woods is actually the creek that goes back of the thing. And this is a very busy street of Riverside Drive. And then you have a decent single-family homes located here. And that's why this is all called Class C neighborhood. And another advantage of this is this has a lot of empty space and all that stuff. So the kids could go actually and play in this area too. And then this is actually the property where it is located, where I'm showing. And then this is actually downtown Fort Worth. And this is actually, the downtown Fort Worth actually is revitalizing with multi-billion dollars. A lot of money is pouring into the downtown to rebuild this. And one of the prime example is, medical district is actually developing with 30,000 employees. And also around the neighborhood of Texas Christian Academy, where the number one is another dot is showing, it's also all the neighborhood is changing. So we are hoping in next 5 years, this whole area will change into a better neighborhood. But that's not the reason why we bought this property at this time, but that's the hope that that's going to happen later. If it happens later, we will be obviously capturing a lot more value. But the reason why we bought this property is this is actually offered at 15% lower rents, and we bought it at a higher cap rate, so we would like to improve the quality of tenants and everything and decrease the cap rate. So that's the purpose we bought this. This is the neighboring properties, sale comps and everything. So the blue dot here is actually the property where the property is located. And then I go and compare this with this chart here. The Autumn Chase Apartments is actually a Class C property, cap rate of 8.2, built in 1969. And it's 185 and 8% vacancy. We bought it at 7.76 million, where each unit is approximately 42K. And then there is another apartment complex here, Monterey Apartments, which is also built in 1969, which is having more than 100 units with a vacancy of 3%. purchased by another buyer at in March 2017, and with approximately $60,000 per door. But then if we come back here all the way to the end, which is Las Mariposa apartment complex, which is actually, if you look at the vacancy factor, it's actually 16% vacant. And this is a foreclosure property, and with a lot of deferred maintenance and everything, and that's what it is sold in 2015 for $20,000 approximate per door. So why I'm showing this is basically I want to show the difference between the cap rate and the sale price. So if these two properties are built at the same time, and if these two properties are achieving the same cap rate, then the per door price should be approximately the same, because the number of doors obviously makes more price increase, but it should be the same price per the door. But here, that's not the case. This property was sold at 7% because it's already stabilized, it's already current at the market rents, and it's already captured all the upside. And also, most of the deferred maintenance is already done by the seller. So the new buyer is buying at a very low cap rate. So to give an example, if we purchase this property at a 7% cap rate as is, we would be paying $9.3 million just for our purchase price. However, we purchased this property at $8.2 million cap rate. Sorry, 8.2% of cap rate for a $7.76 million. So we purchased the property at which is 185 back in July 2017. As I mentioned to you, that is a Class C property located in a Class C neighborhood, and lots of improvements are needed. And most of those improvements are actually interior of the units, because the present owner did not do any interior upgrades. So that's why they are actually below 15% on the market rents. So the interior upgrades could be countertop resurfacing, bathtub upgrading, flooring upgrading, either with laminate floor or with the ceramic tile or with a new carpet. And all wet areas, it could be a ceramic tile would be preferred. And brushed nickel fixtures, because that's where people are, every tenant is liking to pay a little bit higher rent. And a good two-tone paint will do that. And the good part of this is because it's already 95% occupied. So we really don't have to do all the units at one time. As the unit turns out, we can actually do that, improve the interior upgrades and increase the rental rate. So that's why it's a little bit time consuming. On the exterior side, we can all finish all this in less than 6 months. The roofs are in good shape. Gutters needs to be installed. Since there are no gutters at this time, there was some soil erosion happened, so we had to do the soil grading. And obviously, it will use the new signage because the present signage is not that attractive. So we're planning on doing all those. And also, it will take a good resurfacing the parking lot with the new striping, with the parking spaces and everything, along with the exterior lighting. The fence also requires some kind of repair, because you have seen that in this picture, all the property is in the wooded area. And that way the fencing is very important. And once we get that, then we will attract more to the rental revenues. If we do the exterior upgrades, we may not increase the rental rates, but it will increase the traffic flow. What it really means is if we have even one person per day, that will give us 20 more people in a month, and then that will give us to choose a better qualified tenant to pay the higher rent. So that's the reason why we had to do in all apartment complexes the higher the exterior repair, because we can attract more traffic. So the present rental rates are actually 15% lower compared to the neighborhood rental rates, as I mentioned earlier. And this can be achieved by improving the interior conditions of the property, and also by getting higher paid tenants, which will give us more increased valuation. So the valuation can be increased by two ways. Valuation can be increased by, what I mean is, increase the NOI by doing all this, and also decrease the cap rate. So once we improve the property and once we improve the tenants, the quality of tenants, the property valuation can be changed by also lowering the cap rate. We have to sit down with the appraisal and all that stuff, but it can be done. So,
but Siva, just still here. I mean,
sure.
If you increase your net operating income, your NOI, then you do increase the value of the property dramatically, whether the cap rate changes or not.
That's correct. So that's why these are two different parameters. We can increase the valuation by NOI, or we can also increase the NOI by improving decreasing the cap rate. So that's what it is. Yes, you're absolutely right. So we plan on distributing 8 to 10% annualized cash-on-cash distributions every quarter from our operations cash flow. This is quite possible because we are already at 95% occupied, and we're also getting the 8% based on at the purchase valuation. We are getting 8%, so we have to increase very slightly to get to 8 to 10%.
So Siva, let me just understand that. So your investors, when you bought this, you got a loan, and then you also had some investors that helped finance it. Your investors are basically getting 8 to 10% return on their money, correct, each year?
That's correct.
Okay. So over a period of 5 years, they're getting about half their money back, correct?
Total of 50%. That's correct. That's our plan here. And they're going to capture the remaining 50% at the time of the sale. And so we can double their investment money in 5 years, or on an annualized basis, it's a 20% return.
Okay, great. So you basically get about 50% of your money over again returned in the cash flow, and then you make another 50% of your money upon the sale at the end of 5 years from the appreciation and the increased value that you forced to happen because of increasing the NOI and possibly decreasing the cap rate. So you basically, as you said, double your money in 5 years. There you go.
Thank you, sir. So this is what the deal is in overall. So we purchased the property at $7.765 million, and the cost of improvements is $1 million. Soft costs are $335,000. Present NOI is $635, and the present cap rate is at 8.2. And the expected NOI, we want to improve the NOI to $775, and this is purely because by improving the interior upgrades, as I was mentioning it to you guys, they're less than 15% lower rents, and we are increasing the rental rates, and we will capture additional revenues either by charging for parking fee, or by collecting more effectively the late fees, or collectively washer and dryer income, and all other revenues. And we're also expecting to decrease the cap rate from 8.2 to 7.5, and thus by where expected valuation should go up to 10.3 million approximately. And the duration of this project is going to take for 5 years. And so once we actually get to 10.5 million, our total cost here is 9.2 million. So we are effectively increasing 1.5 million of the investors' money. So if I take out the down payment and cost of improvement, soft costs, our total investors brought in 3.1 million to the table, and they're actually increasing 50% at the end of the sale. So that's where we are capturing that 50% that we mentioned earlier. So they're capturing the remaining 50%, the cash on cash returns from the operations during these 5 years, since this property is already highly occupied. So this is a typical example of a case study of where the investors are going to make double-digit returns on a Class C properties. Here in this case, we are expecting to produce 20%. We will get back to you, say, probably in 5 years, and we will recapture how we did this. That's it, Phil, for today.
All right, sorry, I was just unmuting myself again. And well, Siva, you knew what I was going to ask next. Lessons learned from this deal. Some of the lessons learned.
Yeah. So the lesson, there are several lessons that we learned. Even though I was investing in commercial and single family since 2008, I never heard that you get a flood insurance for one building out of several buildings that we own. What happened here is, as I mentioned to you earlier on the map, the property adjacent to that is a creek there. So one of the buildings has a lower elevation levels than normal. So the lender actually made us to buy flood insurance. Actually, not only the lender, but also the insurance company made us. And also we thought that we need to protect our investors. So we bought the flood insurance for that building. But the flood insurance is not uncommon. We will buy, but here what it is we had to buy only for one building, and that's what it is. They did not ask for the remaining buildings. So, and the remaining building elevations actually came out very good. So that is the important thing is sometimes when you're dealing with commercial, you had to deal each building separately. So, and that's what we learned here. And the another important thing that we normally do is we try to place the leverage at a lower cost as much as possible. So in this case, we placed a small business Freddie Mac loan at 4.24%, fixed for 10 years. So that means even if in case the inflation happens or something, turbulences happens, there are market fluctuates, we have still a very low 4.24 fixed rate. So our mortgage payment is going to be stable for the next 10 years. So we can ride the wave and we don't have to worry about small turbulences. So that's another important thing that we actually put on thing. And on top of that, since the cost of money, borrowed money is less, so we are actually increasing our return to the investors. So that's another important thing that we learned here. And another important, very, very important thing that we learned is this seller is actually a very, very sophisticated seller, and they are very knowledgeable because they have nearly about $500 million worth of assets. So and the property management also well versed. But when we asked for due diligence, they actually underestimated us, or maybe we don't know what they thought. They never thought that we are going to do full due diligence. They thought that we are going to walk a couple of units and things like that. But again, we always stress that never assume anything unless it's all clear. So when we stressed the seller that we had to look at all 185 units, and obviously he was not prepared for that. So because they never gave notices to the tenants and all that. So we had to come back. So we actually we left the property, didn't do the due diligence on that day. And we went back and stressed on the contract issue. And we stayed 4-man-hour thing that we had to do full due diligence, and he has to allow it. So then, on a mutual agreed date, the next 2 or 3 days after that, we went back and we did the full due diligence. So that's another thing. So we should not assume that everything is okay until we actually see that. Otherwise, we never know. So if there is 185 units and 3 common areas, I highly recommend all of you to go and visually look at all 185 units plus 3 common areas without any exceptions.
All right. Well, thank you so much, Siva, for presenting this very interesting project and this very interesting deal. Yeah, this is yet another example of how somebody can essentially invest in commercial property and essentially double their money in 5 years, which is typically the type of a benchmark that most of these projects are looking for when they're doing multifamily projects. So thank you again for presenting this very interesting project. Congratulations on acquiring this one, and I know you've got lots more in the pipelines. And thank you all for listening to this week's Canis Major Deal Blog. Thank you, everybody.
Okay.